Hello, this is Richard C. Wilson with the Family Office Club. We're doing an investor mandate interview today with Charles. Welcome, Charles.
Thank you. It's great to be here.
And what type of investor are you?
Okay, well, I'm like many angels and VCs, I focus on seed and growth stage, usually tech companies, which is an asset class characterized by high risk and high return. And on cap tables, I appear three ways. I might appear as me personally as an angel investor. I might appear as which is a small family office. We have that in common. And I might appear as an SPV of which is my main identity. That's a fund serving individual accredited investors and larger investors such as family offices.
Okay, great. And technology is such a broad space. There's manufacturing tech, there's health tech, there's fintech. There's 500 other little niches that you would know better than me because you focus all day long on tech. So if you were to scope in the geography of what types of tech companies you look at, but also the sub niches that get the most traction with you under those three different roles where you could show up on the cap table, that'd be great.
Okay, well, I do the same kind of investing just with different size checks in all three of those identities. The parameters of my investment, first of all, I have a global purview. I really focus on North America and Europe, but I do some in Africa, Middle East, South America, Pacific, etc. My preference is strongly for equity or the equivalent, rather than debt.
Okay.
And I'm a multi-stage investor, so I usually take an initial stake, 5 to 6 figure range, and then I increase it to 6 or 7 figures as the enterprise is proven and justified, up to overall enterprises in even 8 or 9 figures.
Sure.
Now, my mandate, and I'll get to the subsectors in a moment, but my mandate is twofold. One is financial. I seek an overall IRR of at least 25% per year. And given the risky field that I work in, I know that some of my companies will do very well and some will be complete busts. So right. I look for a proposition of at least a 10x return in 5 years as a minimum threshold. Some will do better, some will do worse.
Okay.
And then beside the financial mandate, I have an impact mandate. So first of all, I want to provide professional execution, network deal flow, financial strength, et cetera, for all accredited investors, even those who don't have the time and resources to do it themselves. Mm-hmm. And secondly, all of my investors, whether they're individuals or family offices, should feel that all of their investments are impactful. They should take pride that everything is innovative and makes the world a better place. So I think I can achieve the high returns with those additional impacts.
Sure. Okay. And what's your number one type of tech company you're trying to source right now that you'd like to get through the Family Office Club?
All right. Well, I usually look for seed or companies at the first customer stage. They're usually deep technology fields, meaning they're hard for non-specialists to really understand.
Okay.
They meet the financial and impact mandates that we spoke of. What that translates to practically is more than half of my work is in the health or biomedical field, with strong components of energy, materials, sustainability, et cetera, following. And I prefer companies that have an IP or some sort of protective, sustainable advantage. And usually they produce some sort of a concrete product or consequence.
Okay. And what would be the number one piece of advice that could save an investor $100,000 or make them $100,000 or just save them a bunch of grief that you wish you knew 20 years ago?
All right. Well, I'm going to start out with 2 givens and then I'll lead to the advice.
Sure.
2 givens are, I've been to many of your events and I respect and admire the people who have amassed, big pocketbooks, but they're usually working with lower risk, less innovative, purely financial type deals. And those are more easily analyzed by spreadsheets of historical numbers and returns. Right. In contrast, when we're sourcing and evaluating riskier and high return deals, we need a different network. We need deeper technological resources and judgment. We need more time and human interaction because, in summary, we're looking forward with less data rather than backwards with more data. So the 2 consequences of that, the distillations. 1, you have to treat this as an asset class, however much you allocate to it, right, with necessary diversification. If you try to pick a few winners You're not smarter than everyone else on the planet, and I guarantee you will lose money. Secondly, if you don't have the background, resources, time, etc., to do this, don't pretend or fool yourself. Partner
Right.
with specialists who do.
Right. Great. Yeah, I appreciate you bringing that up. And I think the specialty background to conduct the due diligence is so critical. If you imagine the smartest rocket scientists in the world are bringing in a Bill Gates to look at a specialty surgical practice that's selling, or a new fintech company. Well, Bill Gates is a bad example for that, but someone who doesn't have all their background in the niche space, and you find 3 people who have sold their fintech companies or sold their surgical practices, they're going to have just such a depth of nuanced knowledge versus what, it doesn't matter how sharp you are or how much money you have, you're not going to be able to navigate that deal fluidly, and you won't have the intelligence to de-risk it, I'm guessing. That's essentially part of what you're saying right there, right?
Right. Well, I have a lot of background. I spent most of my life in the first computer science field and then in the biomedical research field.
Mm-hmm.
And so I don't know everything, certainly, but I think I know something about evaluating other experts.
Sure.
You can find Nobel Prize winners who say yes and others who say no about the same proposition. So just because a luminary backs something or supports it, that's not enough. You have
Right.
to probe and check and do your diligence even on the luminaries and their arguments. So
Right. Right. And their biases and motivations and how much they invested, whether they invested $10,000 or 10 million
luminaries have not done that. They don't have the skin in the game.
Right. Maybe it's got advisory shares to invest something symbolic.
Right.
So I think that right there could save someone $100,000, not being persuaded by just some anchor investor supposedly came into this deal. So now everyone should follow them blindly, whether it's a good deal or if you're driving off a cliff. I think that could help a lot of private investors listening here.
And I know from my background in research that there's always different opinions. And, I think I'm smart as other people, but I know I don't know it all. And so I listen and
Right.
I always work with and invest together with others. I have
Sure.
colleagues who like to run a whole deal by themselves, but I think that's a little bit foolish.
Right.
And, I sometimes tell people there's so many sides to every issue that I argue with myself in the shower every morning.
Right. And if you don't, you're actually the crazy person probably, right? So appreciate that. So what's the best way for someone to get in touch with you, Charles? Is it, do you prefer LinkedIn, email, phone?
Email or phone are the two things. I don't do any social media, so I'm
Sure.
a retro dinosaur in the LinkedIn, what's up, what's down, that sort of thing.
Sure.
.com is the email, and I'm happy if someone wants to call me, but it'll usually devolve to an email exchange of information and
Right.
conversation.
Right. Okay. Great. Well, appreciate your time here today in this interview, and hope to see you on one of our virtual investor discussion panels or another event we're putting on here soon.
Well, very good. Thank you very much, and enjoy
Thank
the
you.
warmth.
Yeah. Enjoy the snow.
Okay.
Take care.
Bye.
Bye.